Hello, my name is Samantha Holland. I'm a partner in our litigation team at Gowling WLG, but with a specialism in insurance. With a collective 50 years experience of working in the insurance sector, my team and I are usually the first point of call for our commercial colleagues when they're wanting to sense check an insurance clause in a commercial contract. I appreciate that insurance can seem a bit like a minefield. At our recent Think House seminar, my colleague Susanna Fink and I took on the role of a customer and a supplier negotiating an insurance clause in a fairly typical supply contract. Fortunately, you'll be spared of my acting skills today, but the idea of this video is for me to talk you through a few of the typical sticking points in the negotiation of an insurance clause and to flag a couple of things that you may be missing in those negotiations. I'm going to focus on one particular type of cover for the purposes of this talk, being public liability cover, which is probably one of the most common policies come across in an insurance clause. So firstly, what does that policy cover? Well, it covers the insured's liability for claims made against it by third parties for personal injury or damage to their property. So if the supplier or one of its employees does anything which causes one of your staff to injure themselves, or does something that damages your premises, you'll need to make sure that they have adequate public liability cover in place. But there are a few quirks to be aware of when it comes to public liability policy. Firstly, the policy will exclude cover for damage to property that is in the care, custody and control of the insured. The courts have given us some guidance on what that means in the 1982 case of Orion Foster. And that suggested that for property to be in your care, custody and control, it must be in your exclusive possession. That's unlikely to be the case when your supplier is working on your premises, when you still have the right to access and use those premises. But it is something to think about if your supplier is taking your property off-site to work on it, or they're delivering it somewhere, as that may mean that the property is in their care, custody and control, and they won't be covered under their public liability policy for damaging that property. So you'll need to specify in your insurance clause that their policy includes a carve out from the care, custody and control exclusion so far as your property is concerned. Secondly, a typical public liability policy covers claims by third parties for personal injury or property damage, but not financial loss. It's important to think about whether there is a risk that your supplier could do anything that might lead purely to a financial loss, which is not consequent upon any personal injury or property damage. For example, a printing error in the ingredients list on your packaging that needs correcting. If so, you'll need to amend the insurance clause to require that your supplier includes a financial loss extension to their policy. And finally, a typical public liability policy also excludes cover for liabilities assumed in contracts that might not otherwise exist in tort. That's something you need to bear in mind if, for example, there is an indemnity in your contract, as there may then be some losses that you should be able to recover under the indemnity that you wouldn't have been able to claim in negligence, and which the supplier isn't then covered for under their policy. You'll need to ask your supplier to add an extension to their policy for contractual liabilities. So that's what the policy covers. But you'll also need to give some thought to how long the supplier needs to hold the insurance for. And that depends on whether the policy is claims made or events occurring. Events occurring means that the relevant insurers who are liable for the claim are those who were on risk when the event occurred, which may, in the case of something like an industrial disease claim, have been many years ago. If the only policies that you are asking your suppliers to maintain are events occurring, then they only need to maintain those for the period over which they are performing the contract. Conversely, claims made policies mean that the relevant insurers who are liable for the claim are those that were on risk when the claim was made, which could be many years after the event giving rise to the claim that occurred. If the policy is a claims made one, it's important that cover stays in place for as long as there is the possibility that a claim might be brought against the insured. The claims made policy will include a professional indemnity policy or a directors and officers liability policy. Now, a public liability policy is an events occurring policy, which means that it's acceptable for the insurance to be maintained during the performance of the contract. And note, I do mean performance, not duration. You may need there to be cover in place for as long as there are any ongoing post-contractual obligations. There are also a few things to think about when deciding how much cover the supplier needs to maintain. Firstly, you'll need to agree an individual limit of indemnity. That might be a per claim limit or a per occurrence limit, but bear in mind that you may get a number of claims arising out of one occurrence. And even when you have a per claim limit, the policy will probably treat multiple claims arising out of the same occurrence as one claim. So, if your catering supplier uses an out-of-date ingredient in one batch, which gives a number of people food poisoning, the insurers will treat all of those as one claim. You need to give some thought to that. You'll also need to think about the aggregate limit, which means the amount of money available to pay all claims in the policy period. If you decide to specify a per claim limit of 2 million, but stay silent on an aggregate limit, then your supplier could just take out a policy with a per claim limit of £2 million. There's an aggregate limit of £2 million, which means that if there was one £2 million claim, that would blow their limit for the whole of the policy period. So specify a per claim and an aggregate limit. Also consider the policy excess. This is the amount that the insured needs to pay before the insurer becomes liable. Now, you won't want your supplier to have a really large self-insured excess before the insurance cover kicks in, just in case things don't work out for them and you end up having to solely rely on the insurance cover. So you may want to specify a maximum level of excess that is payable for each claim. Also have a think about defence costs. Defence costs are often included in the limit on a public liability policy, and they can erode the amount of cover available to pay a claim. You may need to think about whether you specify a limit that is exclusive of defence costs, or make your limit large enough to include those. Okay then. So we thought about how long the policy needs to be in place for and how much cover should be in place. Do you need to be insured on it? As a customer, you may need to think about what you're actually looking for that public liability policy to do. If your main concern is that the supplier is insured in relation to claims which you may need to bring against them, then you may not need to be named on your supplier's policy. But there may be circumstances in which you do want to be insured on your supplier's public liability policy. For example, in circumstances where you both might incur a liability to a third party, such as a contractor, and they could sue you both. If that's important to you, don't accept any suggestion that you should simply be noted on the policy. That will not give you any rights under the policy itself. And if your supplier invalidates the cover, you'll be left without any protection. Ideally, in those circumstances, you'd be named on the policy as an insured. But that does give rise to some other considerations, such as who receives payment of any insurance proceeds, what happens if another insured invalidates the cover, and how do you ensure that your supplier remains insured under the policy for claims which you bring against them, even though you're also uninsured? However, it is often difficult in practice to get yourself named on a supplier's policy, sometimes because they maintain group cover, and other times because their insurer is resistant to this. Your supplier may suggest an indemnity to principals clause in their policy as a compromise, and that's usually acceptable. Typically, it would mean that you would be entitled to an indemnity under their public liability policy as their principal, so that if you are sued alongside them as a result of their negligence, their insurer will indemnify you too. So having perfected your insurance clause, don't forget to monitor it. Remember to ask for and check copies of the policies to ensure they meet the requirements of the clause, not only on entering into the contract, but also at each policy renewal date. You may also want to agree some sort of claims process so that everyone is clear on where they stand when it comes to making claims under their respective policies. For example, you may need the other party to notify you if they become aware of anything that may give rise to a claim, so that you can let your own insurers know. And you may also need the other party to cooperate with you in the event of a claim by giving you access to documents and potential witnesses, as your insurers may need that information to defend the claim. So I appreciate that that's been a bit of a rattle through some of the key points to think about from a public liability perspective when negotiating an insurance clause. We haven't been able to cover everything today, but do please get in touch If you would like to discuss any of these issues or indeed need any support with drafting insurance clauses or any other insurance issue. Thank you.